Johnson & Johnson is a triple A rated dividend king. They have paid dividends and grown them for 58 years. If you want to see an in-depth analysis of Johnson & Johnson to determine whether it belongs in our portfolio or not, stay tuned. Hey guys, welcome back. This is Kevin Burgess again with yet another analysis of a company this time that is very well known and probably needs no introduction. It is Johnson & Johnson. I've invested quite a few hours in looking at their 10K, their Q, their public releases, listening to their calls, and I believe it's going to be an interesting analysis that will help us get to the bottom of whether we want to add Johnson & Johnson shares or sell some off or even just hold the position that we have. If you like these kind of analyses, give this video a thumbs up. If you want to see more like this, you can subscribe to the channel, ring the bell, and you'll be notified of future videos as they come out. Now, as you know, I'm not a financial advisor, so I'm not trying to sell anyone on Johnson & Johnson. All I'm doing here is sharing with you the research that I've done for my portfolio, and hopefully it benefits you in some way and maybe helps you with your portfolio. Every portfolio is different, every investor is different, and you've got to make up your own mind about where Johnson & Johnson fits in your portfolio, if at all. While there's a lot of effort and work that goes into these analyses, I do enjoy doing them and I enjoy sharing them with you as well. And as we work through this journey together, and on this journey of personal freedom, I'm probably further along than most of you. I'm already retired. I retired early, as a matter of fact, and I use passive income to cover my expenses and live the life that I want to live and do the things that I want to do just to have personal freedom. So if you're on this journey as well, regardless of where you are, if you're just beginning or if you're a little further along, then stay tuned and let's take a look at Johnson & Johnson and see if it's a stock that may help you achieve your goals. So with that, let's get started with the analysis. In 1886, the pharmacist Robert Wood Johnson formed a new company with his brothers James Wood Johnson and Edward Mead Johnson. In 1888, the company produced two products, a book called Modern Methods of Antiseptic Wound Treatments, the first mainstream guide to treating injuries, and innovative ready-made first aid kits based off the company's cotton gauze dressings. The company went public in 1944, near the end of World War II. Johnson & Johnson built a reputation for creating improved, mass-produced versions of common health care and sanitation products. Johnson & Johnson, as we know it today, arguably began in 1959. That year, the company bought two pharmaceutical research companies, McNeil Laboratories and, I'm not sure how to say this, Salagchemy, maybe? 2 years later, it acquired Janssen Pharmaceutica NV. This created Johnson & Johnson's Pharmaceuticals and Research Division, which is a critical part of its corporate structure to this day. Johnson & Johnson is the world's largest healthcare company. It also is the highest paid drug company in the world. Its top products include Tylenol, Stelara, Invega, and various other medical devices. They are a AAA rated dividend king with uninterrupted growing dividends every year for 58 years. Let's take a look at their industry and competition. According to Seeking Alpha, these are 6 of their competitors. There are some big companies on this list, but there are also some big companies that didn't make the list. You see that some of their competitors are Roche, Pfizer, Eli Lilly, Novo Nordisk, and Merck. Those are some big names. However, I mean, just think of other ones like Bristol Myers Squibb and AbbVie are missing from this list. Amgen is missing from this list. So there's a lot of competition in this industry. So you can see here, though, that Johnson & Johnson has a market cap of $434 billion. They are the largest in this space. They have 3 segments. The first segment is considered the consumer health segment. It's 17% of their business. It includes a broad range of products that are focused mainly on personal health care, used for skin health and beauty, over-the-counter medicines, baby care, oral care, women's health, and wound care markets. Then they have a pharmaceutical segment. This is 55% of their sales and is focused on 6 therapeutic areas, which include immunology, infectious diseases, neuroscience, oncology, pulmonary hypertension, and cardiovascular and metabolic diseases. The third segment is medical devices. It's 28% of their sales and includes a broad range of products used in orthopedic surgery, intervention solutions, that's cardiovascular and neurovascular, and eye health fields. Competitive advantages, they have a lot of competitive advantages. I've listed what I think are the main ones here, but there are others. They have powerful brand names. I mean, Tylenol, Motrin, Aveeno, Lotion. So this name brands that are readily identifiable brands to people today. They have a strong pipeline of pharmaceuticals. They have technological discoveries and patents around not only their pharmaceuticals, but also medical devices. They have tremendous economies of scale. And this list could be longer, but in essence of time, we will move on. I don't think anybody would argue that they have many competitive advantages. Risks. They have tremendous risks as well. There's competition. We saw that in a few slides ago. Litigation is going to be big, and we'll get into these further in the analysis, but they have product liability, litigation, and maybe some specific ones, and some high-profile ones are the talc and opioids litigation, and we'll talk further about those here in a bit. Operational risks, around technology. They have a lot of technology in their firms, so there's a lot of technological risk from an operational perspective, and also regulation. And I put on here healthcare reform. That is going to be something that's always front of mind for companies like Johnson & Johnson, but also just regulation in terms of product with the FDA and things along those lines. So those are risks that the company faces. I have some takeaways from the 10K, and I thought I would pass those on to you. The research and development expense for Johnson & Johnson, I found this to be interesting because if you look at 2020, they have roughly 15% of their sales dollars that are attributed to research and development. And in the year prior, which was 2019, they had they had 13.8%. I find that to be pretty healthy. So I'm saying that is actually a good thing as they continue to think long-term and down the road, and they're investing in research and development that'll help products moving forward. Another interesting takeaway is that you'll see their income before tax by segment here. In 2020, the consumer health segment lost over $1 billion. And then the pharmaceutical segment increased its earnings, over $6 billion, almost $7 billion between 2019 and 20. So, we have to ask the question, why is that? And as we take a look at some of the information from the 10K, we find that they have higher litigation expenses in the consumer health segment in 2020, which is roughly $3.9 billion versus $0.4 billion in 2019. These are mainly associated with these talc-related reserves. And in the pharmaceutical segment, you see that they have lower litigation expense in 2020. They had about $0.8 billion of litigation expenses in 2020 versus about $4.3 billion in 2019. $4.3 billion was associated with the opioid settlement litigation. And so, in 2019, you see $4.3 billion around opioids. And in 2020, you see an additional $4 billion or so in the talc settlements. So a lot of litigation here. And it's something that while it may or may not be material to the financial results, I think it's important for us to keep that on our radar screen. The company recently announced a restructuring. They're planning to accelerate innovation, and these are words from the company. They're planning to accelerate innovation, serve patients and customers, and unlock value through separating the consumer health business. We're going to talk about that and see if that even makes any sense. So they're going to have a new consumer health company. That consumer health company is going to be made up of the consumer health segment that is in the current company. The remaining two segments, which are the pharmaceuticals and medical devices, will continue to move forward under the Johnson & Johnson name, and it is expected to close in about 18 to 24 months. This is probably 2 to 3 months ago, so let's say it's 16 to 22 months now that we expect that to happen. Does this spinoff really make strategic sense? And let's look at a few items here. Normally, when we hear of companies merging together, sometimes what we will see is they are merging together for synergies. I have to think of that differently and backwards when I think of spinning off a company. So when I think of spinning off the consumer health business, it means that there's going to be different software for the existing Johnson & Johnson and the consumer health company, whatever they call it moving forward. So they're going to have two costs for software. They're going to have two corporate offices. They're going to have two CEOs. They're going to have two management teams. So we're going to end up with more costs than what separately than we would have had together. So, point number one. They will have smaller economies of scale, so they won't be able to leverage buying power of the big Johnson & Johnson by splitting it in two. They'll have higher administrative costs, which we've talked about. They won't be able to allocate their capital as efficiently. So, if they have an X amount of capital to invest in the business, they may be able to shift that from one segment to the other to get the most return for investors. But, they may not be able to do that as readily, having that separated out. One thing to think about is that the consumer health business will lose out on the iconic Johnson & Johnson brand name. That is offset a bit because some of the products that they will have, like Tylenol and Motrin and those kinds of names, kind of stand on their own, but they do lose that Johnson & Johnson valuable brand name. They also lose the ability to offset downturns in other segments. And we saw that when we went through that 10K information. We saw that the pharmaceuticals took a hit one year and was covered by the health segment. The health segment took a hit one year, was covered by pharmaceuticals. So we're going to lose the ability to have one segment compensate for challenges in another segment. Also, just a question as an investor is, will this new consumer health company have a AAA rating? I'm pretty sure that the continuing Johnson & Johnson, the pharmaceutical and medical device company, will keep their AAA rating. I just don't know if the consumer health company will also have a AAA rating. That's to be seen. What the company touts is that they are going to be able to increase management focus, agility, and speed. And there may be something to that, but I guess we'll just have to wait and see. Some of what the scuttlebutt is to help the company separate itself from this talc litigation. If we think about it this way, we have consumer health segment, we have a medical devices segment, a pharmaceutical segment. All of those are at risk if this talc litigation turns into something really, really big. This is information that I found regarding this talc litigation. It talks about an interesting context and divergent views for the spinoff. But just some background, on October the 15th, Johnson & Johnson announced that it had created a separate company with the name of LTL Management. I don't know what LTL stands for. To take charge of managing and paying claims stemming from the talc in baby powder. With the liabilities estimated at $1 billion to $10 billion, this company was funded with $2 billion LTL promptly filed Chapter 11 bankruptcy and is now under bankruptcy court protection as well as restructuring. It looks like the liability for this talc could be anywhere from $1 billion to $10 billion. So Johnson & Johnson created this company, put $2 billion in it, and basically bankrupted it and said, here's the liability that we're wanting to limit ourselves to. I don't know if that's going to be effective in bankruptcy court. We'll just have to wait and see. Another way to kind of protect the pharmaceutical and medical device segments is to split off the consumer health segment, have it be responsible for the talc claims, and then the Johnson & Johnson moving forward is out of that obligation. Again, I'm not sure from a legal perspective. I'm not a lawyer, so I don't know if that's going to work. But we'll have to wait and see on that as well. From an investor perspective, it's important to understand what these potential risks are. The talc litigation risk is a big risk. It's a big deal. Is it going to be material to Johnson & Johnson? I don't really know. We'll just have to wait and see where all of it kind of lands with the courts and with the bankruptcy court and how all of that kind of works together. So the point of all of this is that there's a lot of uncertainty around litigation for Johnson & Johnson. So now let's move on to some of the financial numbers. You'll see their dividend growth has been going on for 58 years. So not only have they had a dividend for at least 58 years, they have had a dividend growth streak of 58 years. You'll see that the growth this past year was 5%. In the last 5 years, the average is a 6%. Last 20 years, an average of 10%. You'll see that their dividend yield is 2.57%, pretty much in line with where it has been for the last 5 years. Their shares outstanding have gone down slightly. Financial metrics, their sales, you can see in 2011 they were at $65 billion. Now they're around $91 billion. So they are up and to the right, which is what we like to see. Their earnings per share and their free cash flow are up and to the right. They've nearly doubled their earnings per share from 2011 to now. And they have also more than doubled their free cash flow from 2011 to today. Their earnings payout ratio is pretty consistent, although it is declining, and that is a good thing. They're somewhere in the low 40% range, and that's a very healthy range to be in. You can see that their free cash flow payout ratio is also pretty consistent and decreasing. So both of these metrics are very healthy for Johnson & Johnson. They have a dividend safety rating of 99. So that's the highest rating that Simply Safe Dividends gives is a 99. They have a AAA credit rating. There are very few companies in the world that have a AAA credit rating. Their net debt to capital, you can see, in 2017 was 0.29. It is now 0.09. So they made tremendous progress from a net debt to capital perspective. Also, their interest coverage ratio is huge. It's 114. So they have no issues whatsoever with the debt load that they're carrying. Valuation, according to Morningstar, they have a valuation of $167. They have a wide moat. And when this video is being filmed, they have a current share price around $165. We're going into earnings week, and things aren't looking so good. So we may actually see this price decline, not necessarily because of Johnson & Johnson, but just because the market will be, I believe, under pressure this week with earnings. Return on invested capital, they're sitting around the 20 to 22% range. That is really a good return on invested capital, so very healthy. In terms of a price target, Seeking Alpha has, based on their analysts, shows an average price target of a 183.5. The low end of that is 161. We are still above that low. However, I think we could actually push that low this week. And then we have an average of 183.5 with a high of 215. The current price is 165. The valuation is around 167. So, in essence, it's fairly valued. So in summary, Johnson & Johnson is a AAA rated dividend king with a 58-year dividend growth history, solid capital allocation metrics, strong financial metrics, consistent and strong return on invested capital, and they appear to be fairly valued at the moment. Litigation risk, however, is very significant with both the opioid and the talc litigation, and the strategic value of the consumer health segment split off is not really clear. So in terms of actions, what am I going to do? I think based on all of this, Johnson & Johnson's a healthy, strong company. I think it bears a place in my portfolio. It is currently the 4th largest holding in my portfolio. I am going to hold the shares in Johnson & Johnson that I have. If the stock goes below 160, however, I am going to consider adding to this position. If it does not go below 160, I will hold the shares that I have and move forward. So Johnson & Johnson is a tremendous company. It has tremendous financial metrics. It has great capital allocation. It has a decent valuation. So it is, I think, a company that I want to have in my portfolio. Whether you want to have it in your portfolio is up to you. Again, the point of this video is not for me to sell you on anything. It is to let you walk with me through this process of analyzing Johnson & Johnson so that you can see what I've looked at, what's important to me, and then how I'm using that to determine whether Johnson & Johnson plays a bigger, smaller, or the same role in my portfolio. Hopefully you can use this information for your portfolio. I'd love to hear from you regarding whether any of this information was meaningful in any changes that you made to your portfolio. But again, your portfolio is up to you. You have to do your own due diligence. I'm just providing you the results of the research that I did. So that wraps up the analysis on Johnson & Johnson. It takes several hours to work through all of the information and determine what I believe is important and not important. So hopefully you find this helpful. I know it's important for me, and I will continue to do it because I enjoy doing it. So I'm sharing this with you free of charge, obviously. So hopefully it is at least worth what you're paying for it. My next video will be on Microsoft. Microsoft is currently the 5th largest position in my portfolio. Hopefully you'll find that helpful when it comes out. So with that, I look forward to seeing you on the next video.